Hello and welcome to Livewire Markets. I'm Ali Selby, and today we're sitting down for a chat with multi-asset specialist Anthony Galawenko from MLC Asset Management. Thanks so much for joining me, Anthony.
Thanks for having me.
First up, we've seen markets around the world continue to reach new highs while bond markets have really shrugged off inflation concerns. Why do you think a macro view of the market is so important in this environment?
Well, thinking about really four key forces that are pushing in on our central sort of frame of mind, which is the inflation outlook. So as you mentioned, equities at or near record highs, reporting very robust earnings on average. We've got bond markets at or near record lows, where we've had considerable central bank influence. So central banks, both conventional and in particular unconventional policy, really pressing those yields to record lows. And all amongst that, coming out of the pandemic, you've had fiscal taps certainly turned on. So all of those things, as I mentioned, pressing on in the inflation outlook, and that's where we're focusing. Now, the relevance and why we believe that to be relevant comes down ultimately to tailwinds, headwinds, crosswinds that ripple right through. And I'll use the example of real yields and real cash rates. They remain at record lows and having an influence in really elevating asset prices. So at MLC, we have a proprietary investment futures framework. We utilize that really to consider a wide range of potential outcomes and wish to position our portfolios to deliver both diversified, consistent, and importantly, resilient outcomes, no matter what future we see.
With that in mind and dusting off your crystal ball, are there any risks that you see in the future that could impact markets and investors' portfolios?
Well, I think the most obvious risk is valuation levels and asset prices. At MLC, really what we're trying to do is judiciously deploy capital. Now, where those valuations are elevated, where prices are higher, you tend to have a more amplified or magnified response to disappointments, either in results or disappointments, coming through earnings. So where a company, and using the example of the most recent reporting season, could be delivering very, very strong, very robust earnings themselves, if that's not meeting elevated expectations as a result of where those prices are starting from, you can see an amplified decline in price, and that's what we've seen. So really that first risk, and probably not rocket science there, just saying the amplified risk due to elevated valuations and particularly optimism. The next risk really is in this, what I'll deem transfer or translation from on the couch consumption around goods to off the couch, which many of us in Australia are certainly looking forward to. And it's that pivotal transfer from on the couch to off the couch, moving to services that are going to underpin ultimately where we want to get to in full employment or moving to full employment, and also where we want to see robust real wages growth, and that's some time away. So the translation and on the couch to off the couch being the second one. And the third one, and if I think about that, is really this period where we are now, elevated valuations, certainty in it, and that's as simple as central banks. How are central banks going to navigate a tricky signaling to markets? How are they going to? We may see some of that coming out at the end of this week in the Jackson Hole Symposium. Some clues as to that tapering of quantitative easing, and that's, as I mentioned, had a dramatic effect right across all risk markets and all asset prices. And that process, what's going to be multi-year, but needs to be carefully considered and importantly well telegraphed to the market. So there's sort of three risks that we're thinking about in positioning our portfolios.
Okay, so those are the risks. Are there any opportunities that MLC has identified that you believe are currently being undervalued by investors?
Well, it's a difficult environment. As I mentioned, valuations are quite high. So there's individual pockets that are interesting to us coming through the reporting season and out of the US, out of Europe, Japan, and locally now as we're getting through our reporting season. In the listed space, real estate investments and the REITs are certainly something we see having appeal in that mid-risk category. And I'll use mid-risk to sit between equities and private equity, more sort of higher return, higher potential outcomes, and traditional, more defensive investments around fixed interest and credit. So mid-risk assets, real estate investment trusts, focusing on quality underlying high quality property, long leases. And what we like about that is delivering a foundation of regular income. There's a rental escalation, which over time we see growing. I'll caveat that with more discretionary based big box retail, where we're still awaiting and we still see some risk there. So that's an opportunity. Expanding on that and probably taking a more global view in listed market in the infrastructure space. We view that prices where they are factoring what are a few wrinkles or a few warts, if you like, in that on the couch to off the couch services and leisure segment. But again, focusing on quality, focusing on some element of inflation protection. So we've got a usage or tolling or tariff that will keep pace and in some instances exceed inflation. Those sorts of investments are interesting to us. And the final one, probably less so an opportunity and more something that's really useful in this environment, and that's diversification. So diversification in going global for growth style investments. We believe that foreign currency exposure is something that needs to be purposely managed and very deliberate in those exposures. And should we see periods of uncertainty, should we see periods of volatility, that's a valuable cushion that we see in as part of that diversified resilient portfolio.